So now we will shift to another of our esteemed Rotarians, Jeff Rosensweig. Jeff is director of the Robson Program for Business Public Policy and Government at Emory Business School. Professor Jeff, you have that glow of newlywed upon you still. And we're so excited you're here. Jeff, as you all well know, has his own incredible background and strength in finance and global economics. I can think of no one more talented and qualified to introduce our featured speaker today. So, Jeff, I will turn it over to you.
Well, Catherine, Bill Hennigan gave me a big responsibility, this being your inauguration. We wanted a speaker who is globally respected and known, who is a great communicator, highly skilled and brilliant, and can give us very practical information. Well, we were fortunate to get our first choice, Rick Rieder, who's the head of anything that happens in fixed income at Blackrock. Blackrock is arguably the world's leading financial firm. In fact, the leading financial institution might be the Federal Reserve. Rick has been a key advisor to them for many years and continues as a key advisor. Rick, I want to make sure we save a lot of time for you, so I just wanted to hit some highlights. You've been on many boards, such as the U.S. Olympic Committee, but people have your bio. There is one thing I want to mention is to back up my claim that you were a great communicator. I think you show up more on Blackrock, representing Blackrock on CNBC and Bloomberg than anyone else in the private sector. We really are so proud, not just that you went to Emory, but with your concern for education, that you're on a number of our boards. You started an investment fund for the students, which has grown dramatically. And both of your daughters have come to Emory and done quite well. So I just want to summarize 4 things. Number 1, great communicator. Number 2, you're chairman of the investment and the allocation committee at Blackrock, which allocates $2.7 trillion of assets under management. You have an MBA from Wharton and a great interest in education. And I hope in our questions we'll have time to get into some of the innovations you've done in urban education in Newark and here in Atlanta, where you've received major awards for your concern for K-12 urban education. But Rick, the final thing I want to say, since I know you, is you're one of the people that somehow achieves the pinnacle of career success and yet with life balance. A wonderful, close family. Both your daughters did very well at Emory. I'd like to learn a few things from you today, and we're just proud that you've spent time in Atlanta and at Emory, and that you're our speaker for Catherine's inauguration.
Thanks, Jeff. Thanks a lot. Thanks for having me. By the way, I say it when I travel all around the world. Atlanta is my favorite city, and I've asked my CEO if we can move there, and he doesn't seem to be so keen on the idea, given our headquarters in New York. But anyway, it's a thrill to be a part of it. I mean, obviously, my heritage at Emory, both my daughters, met my wife at Emory, and so anyway, it's a thrill to be a part of it. So thanks for having me. So maybe I'll kick off. I don't know where Jeff went, but I'll say a couple of things. So I brought a presentation that maybe I'll just spend 15 minutes. I'd love to get into questions and thoughts you all have. And the presentation that I put together here. So it's, by the way, it is from a call that I do monthly. Jeff, I was going to dive right in. Is that okay?
Please. I'm sorry. And speak up a little bit.
Okay, no problem. So anyway, I do these monthly calls to talk about markets and the economy, and I thought I'd share a few high-level thoughts around it without going through. Use a lot of data, a lot of graphs, and without going through all the nuance around some of these things or burdening your eyesight. I'll try and get through some of what I think are the major key themes for both the economy as well as financial markets. So the title of this is Markets Today Like to Simplify Everything into an Emoji or Tweet to Know that Things Are Either Good or Bad. And I find it ironic that, people just want, and, whether it's a Twitter-driven world, social media-driven world, and they just want to say, okay, I just want to know, are we in inflation? Are we in reflation, inflation, stagflation? I just need one word. I just want to describe it. Is the economy hot or is it cold? Is the Fed hawkish or dovish? I just want one word and I can get on with the rest of my life. I want to talk a little bit about, I think it's a bit more complex than that. And I'll hit 5 or 6 points that I think are describe where I think we're going and some of these major issues. If you go to the next page, let's talk a little bit about, again, this is where I put too much text on a page and because it's came from this presentation. But I think there has been, over the last year, there's been 3 economic and investment regimes. The first one has been the recognition that we were in a pandemic. And quite frankly, I thought it was remarkable. And I didn't believe, actually, and maybe I was a bit slow to recognize, gosh, think about it, the economy could be shut down in many ways for what has here been about a year and a quarter. I'll talk a little bit about how the U.S. economy and the global economy is incredibly flexible and adaptive. But to think that the recognition we were in a pandemic, and from an investment point of view, that was when we were obviously manage a lot of money. The first thing we're thinking about, we got to raise cash, because who knows how much people will need for liquidity? Who knows how long we're going to be in this thing? Regime 2 was an incredible amount of fiscal and monetary policy that came in and around that period, April to June. And from an investment point of view, it was get interest rate exposure on, and also you could take some risk because you knew you had the Federal Reserve and in Europe, the ECB, and you knew you had fiscal policy coming in. The ramifications, difference between regime 1 and regime 2 were incredibly different. We didn't have to keep raising cash. We could actually put money to work. Regime 3, I would typify by saying vaccine, in the one-word answer where we live in, is vaccine had come to the fore, and the recognition that, gosh, the economy can actually start to reopen, people can start to travel, et cetera. Then it was reduce your interest rate exposure, also buy some equities or continue buying equities. And the point I want to talk about now is I think we're actually entering a slightly different regime. And that is, without getting too technical, I know there's a whole myriad of different people in markets, out of markets, but this regime's a little different because I think you're now having what will be a subtle transition from monetary policy, meaning I think the Federal Reserve can start to pull back a bit. I think it'll be incredibly deliberate, but it has real ramifications and I'll talk a little bit about whether you take risk and how to think about interest rates alongside. So go to the next page. And just to classify this, again, too much text on the page for a presentation like this. But what I put on the left side is I talked about what Chair Powell said and I put in red what he said in his last press conference, that if you look through the current time frame and think 1 or 2 years out, we're going to be in a very, very strong labor market. And then he talked about, for those of you who follow the upper right, these dots, these are where the Fed governors and presidents expect interest rates to be. And we first started out and said they're not a great forecaster of future policy. But then at the bottom, he said, but many market participants are comfortable that economic conditions have been met sooner, that will be met sooner than anticipated. Big deal. So meaning the Fed is starting to shift to what is not restrictive, not tightening policy, but not in an emergency world that we've been in terms of financial policy. I'm going to throw out one more nuance to this. What I put on the bottom right, it's always hard anticipating where the Federal Reserve is going to guide interest rates when you don't know who's going to be at the Federal Reserve in 2022. So, we're trying to think about how do we position our portfolios, how do we anticipate interest rates, economic conditions. But Chair Powell may or may not stay on as chair. Vice Chair Clarida is presumably leaving in January. Randy Quarles is presumably leaving as the Vice Chairman of Supervision. So anticipating where this Fed's going to go is tricky because you're not sure who's going to be making that call. So anyway, something I'll throw out there. And in fact, maybe to put it a bit in perspective, I actually think from a market's point of view, whoever takes over will probably not move interest rates quickly and will not taper policy quickly. We could talk if you want Q&A about who that could be. Go to the next page. Let's get into the economy a little bit. I'm doing this in super speed mode. But I just want to talk a little bit about what the Fed has described as, we talk a lot about inflation. And you hear people say, my God, inflation is, and you see some numbers like, the CPI report came out there was a 5% year-on-year inflation. People say, my God, 5% inflation. We haven't seen that. I don't know when we've actually seen that number. It's certainly been 30, 40 years since we've seen that. But what the Fed has described as inflation, much of it is transitory. And I just want to talk about how I think they're right. And what you have these incredible skeptics out there saying, my God, we're going to go through this massive inflationary dynamic. I just want to show you there's something really powerful at play here. First of all, on the upper left, that took the auto industry days of supply, meaning their inventory levels have been drawn down to next to nothing. You can't buy a new car in the country today. So you're getting this spike of pricing in places like new and used cars. In fact, almost half the inflation, the spike in inflation is driven by that dynamic alone. Then you look at the chart on the top middle, and we broke down what's creating this inflation, and you see a huge component that's chip shortages and what are reopening components without getting into, well, I'll get into actually on the chart on the right. And when you look at, what is creating this, it's used in new vehicles, and then obviously some of this dynamics around the chip shortage. So meaning when the Fed says inflation is going to come back down to a couple of percent or so, I actually think that is largely right. And then you're going to see some equilibrium with regard to chips. It probably, depending on the industry, it could take 6 months to a year, but I think they're largely right. By the way, the only thing I put on the bottom of this page is there's some things happening. When you get these spikes of inflation, it instigates productivity improvement, i.e., you see this growth of technology that comes to the fore. And then one thing I showed trucking and the growth of autonomous. And when you see, talk about wages in a second, some increase in wages, et cetera, you'll start to increase technology implementation, which will also bring down some of the rate of inflation. Because go to the next page. I sort of talk about one thing around that I think is maybe the most important thing in the economy today. That is the area where people last couple of months have talked about, well, the job improvement is not nearly as impressive as we thought it would be, and the Fed should keep emergency conditions. And I actually don't agree with that at all. In fact, I think this is the hottest job market in history. If you look at that chart on the upper left, that is the job openings to the unemployed. If you look at the chart to the right of it, that's quits, people quitting versus layoffs. Then the chart to the right of that is small business job openings hard to fill. There's some pretty incredible things happening. And by the way, the top right is people actually retiring. So there's two phenomena that are at play today that are actually causing a real capacity problem with regard to people. One is some people have retired, age 65 and above retired. We can debate, why all of a sudden so much of that. Second is the chart I put in the bottom middle is people have the unemployment benefits the benefits have not rolled off yet. You'll start to see that, and they fully roll off in September. So some people are choosing not to come back to work. And then the last dynamic is some people concerned about commuting or otherwise with regard to COVID. Point being is I actually think that the biggest constraint to the economy today, we've seen this, we actually went through this in one of our strategy meetings, hotels, restaurants, travel generally, it's actually getting enough labor to operate, to fulfill the demand that's out there in the economy today. So pretty powerful stuff. Good. Go to the next page. I'm going to skip some of this quickly, but go through it really quickly. So I want to get to any Q&A or any thoughts, Jeff, and want to get into. One, I actually just want to throw out this idea that I actually think inflation, that the Fed's mandate and quite frankly the ECB's mandate, many of the mandates around the world, and from a monetary point of view, are to target inflation in around 2%. And the only reason I did this is too complex a page to go through now, is I actually don't know why we're targeting inflation. In fact, I would argue that a moderate inflation that's below 2% is actually better for the economy and particularly better for lower and middle income people. And I don't really understand we need higher levels of inflation. And I just show things like food food at home, energy. And I talk about it. Actually, you don't want higher bad inflation. And it actually creates a denigrating environment for net disposable income, particularly for lower middle income. It happens to be functionally a regressive tax. So anyway, I do think over time monetary policy should evolve, and that we should actually celebrate moderate increase in prices, but we don't have to target an above 2% number. So go to the next page. So I want to hit one way and finish and talk about where I think we're going in terms of financial markets. One, there's people talk about, you hear this all the time, and as Jeff said, I'm on CNBC a lot, And you hear these people that are alarmists about, when the Fed tapers and starts to pull back on this easy policy, the market's going to have a hard time. I actually think that can't be further from right. If you look at it, just put this, if you go back to the taper tantrum that the number of people point to in 2013-14, when you look at, just look at that chart on the top middle, from the start of the taper tantrum, you look at what happened to payroll, to employment, it just continued to improve. If you look at the chart on the top right, the unemployment rate right through the taper tantrum, you can't even see it on the chart, continue to improve. You look at the bottom left, manufacturing, there was never a taper tantrum. Housing, on the bottom middle, you can't find it. And then the bottom right, the equity market, the stock market actually did well through it. So when you hear these alarmists that, my God, when the Fed tapers, get out of the way, it's just wrong. I mean, in fact, the Fed's tapering from emergency conditions anyway. It's still going to be really accommodative. So I really don't believe that. However, there's something that's important. So if you skip the next page, I'm going to go to one more page to try and finish. I'm going to skip liquidity in markets. But if you go one more page, this is something that's really important that I don't think is in the that I don't think most of the pundits talk about. That the Fed has put a tremendous amount of liquidity in the system. I've actually never seen, I talk about it on TV all the time. The system is bursting with liquidity like nothing I've ever seen before. But if you can see this green line, I'm just not that I spend too much time on it. What happens is it's not only is the Fed putting 120 billion of liquidity a month in the system, but the Treasury's general account, when you create this amount of fiscal stimulus and then the Treasury disperses that money, you actually pump the liquidity directly in the system, directly into checking accounts. And this chart on the green line, what it shows you is this is the pay down of the Treasury's general account, which means this is money going right into checking accounts, meaning the system is actually getting more and more liquid. And if you look at the chart on the bottom right, there's something that's really important, is that actually slows down. In fact, it actually, not to get into the nuance around this, but that immense liquidity that we had in July, or that will end this July, you start to have a different environment around interest rates. And so go to the next page. I'm doing this way too fast, but just in the interest of time. If you look at the upper left and think about why interest rates dropped in March, April, and May, on the upper left, it's when the Treasury dispersed what has been about $1 trillion of liquidity into the system. The difference is when you look at obviously as that graph goes on, that when the Treasury starts to pull back, you don't get that liquidity in the system, you have a very different dynamic. So we think interest rates will start to move higher. I don't think they're going much higher, but we think you can get 25 or 30 basis points higher in interest rates. You should show this on the upper right. This is what happens to commercial bank deposits alongside of the Treasury's general account. Banks get the money in, they've got to put the money in the Treasury market, and then you get this immense amount of demand, and that's why rates have come down. So point being, we hear pundits all the time on TV talking about, where interest rates are going. I think they can go moderately higher, but I don't think they're going dramatically higher. So I think that's hugely important as a backdrop for markets. So let's go to the next page. I'm going to wrap up. We do questions. What about equities? And you see, people talk about the equity market is really high, and it should come off dramatically. Actually, I don't think equities are that high at all. In fact, if you look at the upper left, I show the credit markets, I show the high yield market, and obviously equities have done extremely well. But if you look at where earnings expectations go, we think the economy is going to grow this year well into the 7s, maybe hit 8%. And if you look at the bottom middle, the earnings breadth of the equity market is really strong, and our leading indicators are extremely strong on the bottom right. And if you go to the next page, without spending too much time on this, we think what's happening, what I show on the upper left, not to get too technical for this audience, but I know there's a myriad of people on. But if you look at, traditionally when you're managing money, or you're an endowment, or you're a pension fund, you think about 60% equities, 40% fixed income, and that's worked really well over time. Now we're in an environment where interest rates can move up, and what I put on the chart next to it, that many pension funds, many endowments are actually reducing their interest rate exposure. And actually what can cause the equity market to come under pressure is rates moving higher. So, long discussion about, where interest rates are going and will it shock the equity market? I don't think it's going to shock the equity market because we think rates are going to move moderately higher. But you're seeing some movement, which I think is right, out of traditional rate products and our interest rate products to get more into equity exposure. So I'll finish. Let's go to the next page. Let's skip this and go. You know what? I'll just go right to the last page. Go right to questions. Go one more page and I'll finish. So I did this thing on to do my ridiculously simplistic idea around emojis and the one-word answers. You know, how do you think about asset classes? You know, we prefer the equity asset class, which I think a lot of people do. And with interest rates, we think we'll move moderately higher. You know, we like owning equities. We like owning, we do a lot in residential mortgages, commercial mortgages, what are typified as securitized assets. We think the credit markets are in good shape, and we are on this left side. You know, we think interest rates are moving higher, so we don't love owning short-end treasuries. And I'll just, the thing I put on this table to the right of it, that you know, when we think about investing today, you know, we think you've got to have an intermediate to long-term framework to it. And I put some companies, without making specific company recommendations on here, that we looked at their return on equity. In this environment, these companies are earning 15, 20% return on equities, return on their equity, I should say, and growing top-line revenue. And I put versus 5-year treasuries on the bottom. Even if interest rates don't normalize, 5-year treasuries are getting you no return. But your ability to compound 15 to 20% return on equity, or let alone some of these companies that throw off huge return on equity, is really powerful. So we were thinking about, you know, if you're a client of ours or a client of anybody on the investment side, gosh, if I can compound these return on equities, even if my equity multiples compress, I'm going to be in pretty good shape. So anyway, that's why we're tilted towards equities. We can talk about globally, where in the world. But anyway, that's our general framework. Sorry, Jeff, I'll stop talking. I got a bunch of thoughts, but
yeah, Rick, I think that leads me into a question I've had. As you know, our Rotary, unlike some, you have to be nominated, selected, and it's 500 leaders from all different sectors, university presidents, et cetera. Let's say we average between 40 and 70 years old. We're not financial experts. A number are. We have some Federal Reserve presidents in here. What is the biggest risk to our financial futures? How should we manage this risk? What you just showed me made me think people shouldn't be too conservative. They shouldn't be afraid of having some stock, you know, in other words, equity, some stocks or mutual funds, maybe owning a home. So maybe you could kind of, or maybe even for people in different age groups, what should we do? What is the biggest risk on the horizon, and how do we manage it?
So, listen, I'm not as nervous about, there's a lot of debt going on the system. I mean, everybody knows there's a lot of debt that's going on the system. I actually think we're at a unique point in time where, because of the demographic cycle we're living within globally, there's actually an extraordinary period of time. The growth of pension, growth insurance companies, they actually have a need to be a lender. And so the system can actually absorb more debt than it ever has before. So I'm not that nervous about, you know, the debt burden. One thing that I think it is augur for longer term is the Fed, and by the way, the ECB and the Bank of Japan all have to keep interest rates low, because if interest rates were to spike higher, your question, if inflation were to move dramatically higher, if interest rates, if real rates move dramatically higher, you know, that's a tricky thing, because if you force up the level of interest rates at this level of debt, you create a shock to the system that's untenable. I don't think that is the base case. I mean, it would take some exogenous shock, I think, to create that. I think the Fed's right. I think inflation is mostly transitory. So I don't really think that is out there. Listen, there's a couple of things I worry about, and people say, what keeps you up at night? I don't do a lot of sleeping anyway, but what keeps me up at night is, listen, I think China's become a much bigger part in our relationship with China and the United States. I think it's a big deal. But I think China's growth and impact on commodities, impact on global demand is a really big deal. China's slowing today. We think in the next couple of quarters, we don't think it's a debilitating slowdown. But anyway, we keep a big eye on China today. The other one that I think people underestimate, and I'll leave it out there, I don't talk about it on TV or otherwise, is I think the volatility markets are people sell volatility too cheap. And a shock to the system, you know, that creates, because people sell volatility through all sorts of, where they take, you know, whether it's margin loans, where they take leverage on, whether it's over investing in certain assets, let's just straight sell vol through options. That gives me some pause. I think people underestimate how the financial system, you know, can become dislocated. And the U.S. economy, not the U.S. economy, global economy, is much more tethered to the financial markets and its financial system than it ever has been before. So it's something that I watch quite a bit. We buy a lot of volatility because we think it trades too cheap. And I mean, it's something we watch.
we thought we had a great moderation, and then we had two crashes within about 12 years. The global financial crisis, and then right into this one. A question that came in about a debt overhang and catastrophe is very similar to one I wanted to ask, which is we have spent a lot of money on the fiscal side, on the government spending side, is to get this economy going again. We have to create jobs, but we have added $5 trillion to the gross federal government debt. It won't be too long. It'll be $30 trillion of debt. On the other hand, we have very low interest rates. People are willing to lend to our government at rates even below the rate of inflation. So, number one, do you think we will have a potential unsustainable problem or catastrophe? And how will it likely get resolved if this debt goes to 32 trillion and then 34, which it could with the current spending plans?
So, right. So, listen, I don't, there is a number that they're taking on too much debt. I don't think there is an unlimited amount of debt we could put on the system. However, I do think that, first of all, I absolutely and unequivocally believe that during the COVID crisis, extending or increasing the debt to create a multiplier effect, you needed to create some velocity. You needed to create some income in the system so that we get through this. So I don't think that was unequivocally the right thing to do. There's a limit to how much you can keep doing, no doubt. I don't think anybody knows what that number is. And quite frankly, it's, as you say, it's incredibly sensitive to the level of interest rates. And interest rates stay at close to zero, you could withstand a lot of debt. And particularly the fact that a lot of the debt's longer term. Companies have actually, what they've really taken advantage of, extended their debt profile out. If you do that, and I've learned over the years, as long as you have liquidity and you've extended your debt profile out, you can live for functionally forever. And so I think that is the big thing. Listen, I also think it's dangerous. I think there's a limit. And I would say one thing, and I think there are a number of people, I think Larry Summers has been brilliant on this. The system had the ability to put on more debt. And when you actually look at metrics like your interest coverage, particularly today with rates moderate, and you look at the asset value of the United States. So I do look at a lot of companies look at asset coverage. Boy, the asset coverage of the U.S. is extraordinary. So I think you got to manage it. I think we got to be a bit careful. I think the new stimulus plan phased in over 10 years with some real revenue increases alongside of it. I think that's withstandable. And so I'm not that nervous about it. But when people say, where are we going to be 2 to 3 years hence when this economy slows? Nobody really knows the answer. And I try to invest, thoughtfully for what is going to be the next year or so.
And I don't want to put words in your mouth, but that idea of borrow long term so you lock in a rate, whether it's a 30-year mortgage now that rates are so low, or for the CEOs in the audience, maybe lock in long-term debt because the rates are historically so low. There's a question that you started touching on, which is, there's talk about few trillion here for infrastructure and for job training, sometimes for the environment, things that in and of themselves seem important, obviously, including climate. But how would you prioritize spending? And are we talking about too much spending in an economy that, as you said, your forecasts are, every time you change their forecast, it's for a faster growing economy. Unemployment's going down radically.
Yeah. So first of all, I think, the stimulus from here has to be, it's one thing when you functionally did helicopter money, when you functionally just sent money in a checking accounts. Now you've got to create, the stimulus now has to create real velocity to it, i.e., and I'm a big believer in infrastructure is incredibly important. And, and you do create, I think people underestimate the velocity around that, i.e., when you build that infrastructure, you grow vendors revenue, et cetera, and that gets rated and hiring, et cetera. So there's a real multiplier effect to it. So I think that's hugely important. Listen, as you know, I'm a big believer in education.
That's right.
I think the economy, and I think the jobs that are available, and I think the growth, what should be the growth industry in this country, in the world of technology and healthcare development, has got to be in education. And I think the president has been sincere about that. I think it's a really big deal. And then, I think the things around R&D, I'm a big believer if if you get investment in things like R&D in places like healthcare or in others, those create that same sort of velocity. So listen, I think we've seen numbers at 2.5 or so trillion spent over 10 years, some form of $1 trillion-ish or so of revenue enhancement. Well, I think that can work, and quite frankly, I don't think that creates too much of a burden on accounting. In fact, I think it creates this velocity we're talking about that'll be pretty powerful. But it has to be in the right places because I think just spend to spend doesn't really get into durable growth.
People talk about public-private partnerships, and maybe that's where we need that. Where there's someone's putting a sharp pencil to it. We're short on time, but you
estimate that you can actually, and I think quite frankly, I think Minucci was thoughtful about this. I think others have been thoughtful about this. You can create a real multiplier effect with public-private that sometimes it's not thought of from spending point of view.
Yeah, and multiplier effects is like you say, we can pay for itself if we do this intelligently and create jobs. One thing I want to make sure we get to, because you mentioned the primacy of education as a nation, and in some senses we could fall behind not just China but Korea and Taiwan and many places if we don't improve our K-12. So we're pleased that you help Emory or Wharton, but your focus is urban education, K-12, where it's really needed. For instance, in Newark, hard to imagine a place needed more than there, but also in Atlanta where you've made fundamental changes. But Rick, one thing I appreciate you don't throw money at things. You come in with innovations. So why don't you tell us a little bit about your approach to improving education?
I mean, listen, we say this in my schools in Newark all the time, that education is the key to freedom. I truly believe that's right. And I think the greatest injustice in the country today is we have what is a very unequal education system and not equal access to what is world-class education. And I think, as I said, as the world is evolving, I think that is, A, an injustice today, and B, there are other parts of the world, places like Scandinavia, et cetera, we've seen just world-class, Korea, et cetera, world-class education. And it's not, I don't think it's any mystery that, the developments in technology and the countries that are going to succeed longer term are going to be oriented around superior education. Put that aside from an economic point of view, just socially the right thing. And I see we're super proud in the things we've gotten involved in Atlanta as well as in New Jersey. Mm-hmm. You're watching some of these kids succeed and getting real inspiration around what they can do and whatever they want to do. It doesn't have to be in business, but giving them a chance to do that, I think is I think it's the most important thing we could do. And I'm super heartened by it does. When you put framework around kids and give them a chance to succeed, give them the tools to do that. I mean, it's pretty unbelievable, what they can achieve. So anyway, I can talk for 2 hours.
Yeah, well, I think maybe we'll talk about that another time. But in some sense, we're selfish. We're parents. We're grandparents. I'm a grandparent, but Catherine and Clark, who you both heard from earlier, are parents of kids in high school, Clark also in college. Could you give us, in the final minutes, a little bit about things in your trajectory that led to your success that we could, but for very practical purpose I'm asking, Rick, that we as parents and grandparents and uncles and aunts can think about as we advise young people?
I mean, I don't have any wisdom or success, but the thing I think is, that I'm a big believer in. I see this all, as I said, this to all our analysts and associates that, including last week, that we welcome in our business. I just think, I'm pretty amazed that there's a lot of shortcuts in the world today, and I'm pretty amazed that, you hear people that have a clever idea to get from point A to point B, and I don't know that that's right. I just think that, the right preparation and the right, I see people come into meetings, or I see people that, I think it's all about preparation and thinking outside the box and trying to be a bit unique in terms of how you think about that. But I don't know, I'm pretty blown away in the social media world that we live in today. Yeah. And it's all about not to parody what I had said in this presentation, but the one-word answers, the simple, the short, and I just don't think it's there. Or I don't think that is durable. way for, to succeed. I just think there's a lot about being prepared and being thoughtful about, what is the next node in your life? What is the next thing that you're trying to accomplish, and just have an eye towards that. So I'm not sure I have any broad wisdom on that.
No, but you're right. It's innovation plus persistence. I think maybe persistence and grit are very important. Throwing in my own view and then turning to Catherine, they used to say that physics is applied math and engineering is applied physics. Now you, through your, you as a leader, but also through your demonstration today, I think someone has to know a lot of statistics, applied statistics analysis to manage their own investments, even to speak to an investment advisor if they're not an investor. I'm a big believer that everyone in high school, even if they don't like math, should probably study some statistics and probability and more math, as well as Spanish or Chinese. Would you agree with that? Even if you don't like math, you better not hide from it in today's world?
No, I think that's right. I mean, I think, quite frankly, the most incredible innovation, and I think where where a lot of the investment return is going to come from, things like artificial intelligence, data assimilation, cloud implementation. I mean, all those things are analytically oriented. So
that's right.
I think it's absolutely critical. I think the world we live in is very much down that fairway for a long time.
That's right. And as we turn to a wonderful mother as well as leader, Catherine, I would want to say I believe in freedom, except for telling your kids once in a while they better do things like study the things that will bring the future of careers and of education. Catherine, I know you're doing it right in so many ways. And I just want to say how much we admire you and all you've done for Atlanta, bringing us Ponce City Market, which has revolutionized our city. So I couldn't be more pleased to have you as our president, and I'll turn back to you.
Oh, thank you, Jeff. And thank you. You have been a mentor to so many young people, and including a mentor to me on many fronts. And so I know you're doing the same thing in your own way, and really appreciate it. Great discussion. And Rick, what fascinating insights. Thank you so much. It's interesting when I think about some of the comments you made a few minutes ago about education, and with somebody like you, Rick, who sees all of these opportunities to place your influence and your leverage as you've chosen to focus on K through 12 education. And when I think back about the comments that Clark made and the focus of our own Rotary foundations on youth and education, we are even more aligned than I probably initially recognized. And so it's great to hear your affirmation of the strategic importance of a focus in those areas. And it makes me very grateful for what you're doing, and also for what our foundations are doing and our members are doing. So thank you. I had one last question, if I can ask that. You mentioned earlier about the current economic environment sparking productivity improvement. And I'm curious, any key industries that you see that hitting that sort of rise to the top of the list for you?
So that's a great question. So I do. I mean, I think, first of all, I think healthcare is the most exciting one. I mean, I think whether it's robotic surgery or robotic diagnostics or obviously with this vaccine and cure, I think that is one that I think is good, extraordinary. And I think all the funding on the backside of COVID is going to accelerate that. I'm also pretty intrigued by space. There's a lot of stories about Richard Branson and the Jeff Bezos billionaire race to be in space. I actually think space is going to be fascinating, from the ability to do things like climatic and think about climate more efficiently, think about mobility more efficiently. So I think that's a space that it's beyond whether Richard Branson flew around the planet or not. And I think is really fascinating. And then I think, quite frankly, manufacturing, logistics, I think there's some pretty innovative things that are coming down the pike. So, by the way, I think technology is going to hit everything. I mean, I think in every company, every industry, shipping, et cetera. The people on my call probably know much better than I around specific industry, but there are a few areas where I think it's really exciting from here.
That's great. Well, we hope to focus more on those in our future programming as well, and be interesting to see what bubbles up. Thank you both again. I really appreciate it.
And Catherine, if I can say one last thing, Blackrock has presence now in Atlanta. So, Rick, if you'll come down, I'd love you to talk to people about your innovations in education. Even our president next year, Stephanie Blank, has made fundamental innovations. So it's an open invitation to get together with a group of people and give us your ideas, and let's see if we can continue to move Atlanta forward.
Well, Blackrock chose Atlanta for our technology hub. I don't know if everybody knows that, but we went through, I don't know how many cities in the country and studied, the education, the people, and so we chose to put our hub in Atlanta. So anyway, if y'all invite me, I'd definitely be down more. But it's an exciting thing for the firm.
Yeah. Well, we look forward to seeing you.
Come join us.
That's great. Thank you.
All right.